Hello Sector Watchers, welcome to the 23rd episode of Sector Spotlight for Tuesday the 17th of March 2020. This is your weekly update on sector rotation and anything remotely connected to sectors' relative strength and or rotational analysis. My name is Julius de Kempenaer and I'm your host for today's show. As you can see, this is a pre-recorded version of Sector Spotlight. Obvious reason is the coronavirus that's spreading around the world, keeping the staff of StockCharts in Redmond, Washington stuck at their homes, so they won't be able to help me from the studio. I have my home office, or at least we have an office here at the farm, which is very nice, but it's also a bit surreal and weird because living here outside the city, if you would not follow the news or go into town, you would absolutely have no idea that there is a virus going around, which is pretty much halting the world and bringing it to a standstill, but at the same time crashing stock exchanges around the world, which also makes it extremely difficult to talk to you about actual markets, because it's about 24 hours before Sector Spotlight, this episode, will air, and I could be off by 10% easily on either side, so up or down, doesn't really matter, it goes everywhere. And what I want to do in this show is actually take a step back, look at, maybe get a little bit longer term perspectives, and also dig into a few questions that have been sitting in the mailbag, which we've sort of answered in the show very briefly, but not really in depth. So I might go and go back and pick up a few of these questions and give them a little bit more attention. One of the things that I would like to share with you that came up today, somebody asked me how I was watching the events around the world, or how I was watching the markets. And because of an event that happened over the weekend here, we have a stable with our own horses, but our neighbor has a very big stable with 70 horses. It's a boarding stable, and one of the girls that was riding there went riding outside, and all of a sudden a dog came towards her, started barking. She saw the dog coming, got off the horse, which was a good idea, and but the dog started barking so hard and the horse actually panicked and started to run away while she had him still holding her on the reins. But a horse is like, 300 to 600 kilograms. Do that times 2.2 and you get the number of pounds, and there is no way as a human being that you can hold it on that rein. So that horse started dashing off and just went its way. And basically the only thing you can do is let the horse go, watch where it goes, but 8 out of 10 times the horse will find its way back to the stable before the rider does. And when I was explaining this to someone, the analogy with the markets right now came to me, because I think that the markets now are a horse that's broken loose, and the only thing you can do is watch it go. Don't try to stop it. Don't try to catch it. If a horse breaks loose, you don't want to stop it, because it will run over you. It will run you over, and that's exactly what this stock market will do with you. So my take on all of this is to actually stay cool, keep your calm, watch it go, and probably this market will find its way home much sooner than the riders, and the riders being the investors that are getting slammed left and right. The people that have bought a while ago are being hammered. The people that have sold short like 2 days ago are getting hammered because it's rallying, and then it goes everywhere. So there's absolutely no way that you can make any sense of this. So you gotta let it calm down. You gotta let the horse calm down, and it will find its way home, and then you can pick it up and you can start riding it again. And I think that's the best advice that I can give people right now on what to do with the markets, because honestly I have absolutely no idea, and anyone who tells you that they have an idea is probably lying, because they really don't. Anyway, let's go and look at some charts. Let's just have a quick look at the RRG holding the various asset classes. It's a chart on a weekly scale, and we've seen this before, and it is basically continuing to rotate in the direction that we've seen over the last couple of weeks. In blue, the risk-off asset classes, government bonds, corporate bonds, to a lesser extent real estate and high yield, heading at a strong RRG heading. And then you got inside weakening the stock market, asset class stocks, ITOT, still at the right hand side but rapidly heading towards the lagging quadrant, and inside lagging the big red tail is commodities. It was very weak, it still is very weak, and it doesn't look to improve anytime soon. What I find striking in this rotation is that this asset class stocks, ITOT, is still at the right hand side of that graph, and it only shows how strong this market was until it started to turn around and come down. Because if after 4 weeks of massive declines you're still at the right hand side, it simply shows you how strong this relationship was before things started to turn around. Could be this week, otherwise next week government bonds will move into the leading quadrant, stocks will move into the lagging quadrant, and then we'll have to see how long these trends will start to continue. We move to sectors, in this case on a weekly scale, then we see the same pattern that we've seen over the last 3 to 4 weeks. Defensive sectors on the rise, strong RRG headings, either traveling towards or already inside the leading quadrant, and the weak stuff inside lagging. And remember what I said in my introduction about being able to avoid the bleeders. If you look at that trail of the energy sector of XLE, that is the typical example of a bleeder. This sector, you can't see it on the static image, but if you go to the site, you open up the RRG for sectors and you animate it over a couple of years, you will see that the energy sector already moved into the lagging quadrant in September of 2018, and it has been at the left hand side of this RRG since, with only a couple of hiccups and rotations from lagging into improving and then back to lagging. So having been able to avoid any positions in energy would probably already have given you a head start. What I think is striking on this RRG is the strength of the technology sector still. It is the strongest sector on the RS ratio scale. It's still traveling to the right, which exhibits relative strength at a steady momentum. It's got a short trail compared to all the others, which means that it is a stable trend. A bit surprising, I would not have expected that, but it's still going on. That's what the market is telling us, that's what it's showing us, and that's what we have to deal with. So technology is still a sector to keep an eye on, together with the other defensive sectors. And this wraps up the overview of asset classes and sectors through relative rotation graphs. We'll continue the show with answering some questions from the mailbag, but before we do that, we will go to a short break, so stay tuned and I'll see you back in 20 to 30 seconds. So one of the questions that came in was from Eduardo. He actually asked for the seasonality spreadsheet that I'm offering to watchers of the show. So if you're interested in that seasonality spreadsheet, it's still available, and it will be updated from time to time to reflect the most recent seasonal performances on that chart. He had a question for the show regarding RRG, and the question is, For RRG, can you compare ratio relationships in the RRG grid? I've been watching the SPHB versus SPLV relationship like a hawk and wonder if I could fit all my ratios in one SPY RRG grid. Let's have a look at that, because RRGs are perfectly suited to show ratios and relationships, but probably not what Eduardo means. So I need to go back to my desk and answer that question. So Eduardo was wondering whether he could use RRG to show and analyze ratios, and more specifically the ratio between SPHB versus SPLV, S&P high beta versus S&P low vol. By the way, very nice pair to look at and possibly to trade in a risk on risk off situation. Well, to start with, RRG was designed to show these types of relationships. So if we look at the graph of SPHB on the left, that is the price development, and in the pane below is the relative strength versus SPY. So here we're looking at SPHB versus SPY, and here are the RRG lines versus SPY. And we can obviously do the same for the low vol ETF. And you can already see that although they're both dropping like a stone, the low vol ETF is still hovering above its 2018 lows, where the high beta ETF already dropped way below those. So no wonder that the relative strength for the low vol ETF is crawling upwards and the RRG lines are crawling upwards. Now the way you put that into an RRG is simply by entering those two ticker symbols versus SPY, or basically anything you like, but I think that the SPY makes sense for these two ETFs, and you can clearly see the improvement for the low vol ETF versus the deterioration of the high beta ETF. And then Eduardo asks if he could use RRG to show all his ratios, all his relationships. And the answer is yes, because you can use RRG to show multiple relationships in one RRG. You can also show them, you can even show them on various time frames like daily and weekly. And of course, you can actually play them out and see how they operated over time. Now, reading the question of Eduardo again, I think that what he actually means is if you can show the ratio of SPHB versus SPLV on an RRG. So my take is that he's actually looking at this relationship here, which is the straightforward comparison between high beta and low vol, which actually just breaking down. So that is a big time in favor of the low vol ETF over high beta. It's not a real surprise, but it is, well, maybe it's a surprise. I thought it was quite interesting to see that rotation already started in the middle of 2018 when it rolled over, and it's actually still going down. This ratio versus SPY on an RRG, that's actually not accepted. So what that would mean would be to do the colon here, so say the ratio versus SPY, but that's not accepted by the chart, so we can't do that. I actually played around and I noticed that the system actually accepts this ratio and it will calculate the RRG lines as an indicator. But what you're looking at here is, it's basically a ratio, the ratio of a ratio. So this here is the relative strength of that ratio versus SPY. And then the RRG lines are derived from this ratio. So it's getting a little bit messy and complicated. And I've been thinking about this for a few minutes, and I wouldn't know why you would see this this ratio plotted on the RRG, because if you look at this, it would be, let's say 97, 99. So that would be 97 on the RS ratio. Oh, that's way down there. So 97, it would be like here, is that right? 97, 99, yeah, so it's inside lagging. And the green line is coming from above, so it's actually the rotation is actually from improving going back down to lagging again. That's what it would show on the RRG. I don't know if that, well, you can look at it and the system will actually plot it. If the RRG chart would accept that ticker symbol, then it would plot that line. But the question is whether that is making things more easy and is a visualization that you want to see. So I haven't quite figured it out, but I do like just the straightforward ratio of SPHB versus SPLV, which gives you a very clear message that you should be in low vol right now versus high beta. And to answer the question of Eduardo, can I put all my relationships, all my ratios on the RRG? Yeah, of course. You could basically, you just put all the legs of the ratios that you're tracking on this RRG, and then you will be able to see the rotations, and you know which pairs you want to look at and which things you want to trade, and you can use the RRG to monitor those relationships. So I hope that answers this question. Another question came in from Georgia. She writes to me, I really enjoy your show. Thank you for that. Unlike a fund manager, I don't have to stay invested while also trying to outperform a benchmark like SPY. As an individual investor, I can always go into cash, and lately I've been using RRG versus $1 and including SPY as one of the members of the group that I'm looking at. I can then look at stocks or ETFs or industries that are above and to the right of SPY, and it keeps me out of trouble because I can be sure that the absolute performance is still positive. In other words, in a down market, I won't be tempted to look at industries that may be outperforming SPY just because they are going down slower. I've been noticing that when using $1 as the benchmark, bottoms in equities tend to correspond to minima in RRG momentum, but tops tend to correspond with maxima in the RS line. Is this something you have seen, and if so, can you explain why? Let's have a look at that relationship and see if we can replicate those observations. So to answer Georgia's question, I've set up a price chart of XLK here on the left with, this is my normal layout, but I've just changed where I would normally use SPY as the benchmark. I've now plugged in $1 as the benchmark. So we'll get the price of technology of XLK, relative strength of XLK versus $1, and the RRG lines of XLK versus $1. Now $1 is nothing else than basically a benchmark that never goes down. It's a line that's always 1, which you can still do a relative comparison, but your anchor, your benchmark is just always the same, which pretty much makes it an absolute approach of relative strength. So that totally works, and it's definitely something that I can recommend retail investors who don't have to outperform a benchmark. As such, I think that everybody should try to outperform SPY. I've had a long discussion a while ago on benchmarks, and I think, I don't remember who it was, but someone said, if the market goes up, my benchmark is SPY. I want to outperform the S&P 500. If the market goes down, my benchmark is $1, because I don't want to lose any money. Which makes sense, I guess. So if we're stuck with $1, then this is what you look at here on the left. Now, if you bring that to the RRG, I've just loaded up the sectors here, and this is the one versus SPY. You can change that to $1, and you will get all sectors versus $1. So it becomes an absolute, and then with the recent developments, you can see what that means in terms of absolute strength. This is horrible. I mean, everything is going down, and this is what you would expect. So basically sending you the message to not invest in any equities because they're all going down, they're all moving towards the lagging quadrant. What Georgia does, and which totally makes sense, is to add SPY to that group of sectors. And you just add it to the list and say update. And now we can find SPY here. And if we just make this a little bit lower, just 1 week, that's enough. You can see this basically is the center of our previous chart. Let me quickly put that here on the right hand side. If we bring the RRG of sectors here, let's just put it all there. Now SPY is the middle of this chart, and you see the other sectors scattered around it. We bring this to just 0, and here SPY is over here, but you see that the relationships are the same. So if I look at SPY, XLY is a little bit to the left and a little bit higher. Look at where it is here, a little bit to the left and a little bit higher. XLRE is highest above it, close to the 100 line. Close, yeah, just a little bit to the left and then the highest. So it's the highest and it's a little bit to the left. Staples, XLP, is just to the left of 100 if SPY is there, but you see that when SPY is shifted to the right, XLP is just across that 100 line. And here you got XLK. So the relative positioning is all the same, but with $1, SPY itself has started to shift. So it does give you a pretty good view. By the way, this setup we talked about in a sector spotlight show a while ago, and it's actually the one here of the 11th of February, which was titled Adding an Extra Benchmark to Your RRG, which is exactly what you're doing. We're adding $1 as an extra benchmark, or if you use $1, we're using SPY as an extra benchmark. So I call this double benchmarking, where you have actually two angles to look at this situation. So that totally makes sense because it helps you as a retail investor to stay out of trouble when the market goes down, and when the market goes up, you can choose from stuff that's doing better than SPY. Now, one of the observations of Georgia was that when using $1 as the benchmark, bottoms in equities tend to correspond to minima in RRG momentum, but tops tend to correspond with maxima in the RS line. That if we do that on this one here, we say that bottoms in equities, so let's say here, so late 2018 was a bottom in equities, correspond to a minimum in RRG momentum. Yeah, makes sense here. But tops tend to correspond with maxima in the RS line. So tops tend to correspond with maxima, yeah, pretty much so. And look at this one here with a maxima in the RS line. Interesting observation. Interesting observation. Let's make this a little bit longer. Find, no, this was a bottom here. Yeah, pretty much. I hadn't looked at it like that, I have to admit, but it looks nice. Let's try another sector. Let's try XLU. That's a very interesting sector right now. So again, a high in RS with a high there, and where's a bottom? So here's a bottom. Yeah. The only problem, not really a problem, that I have with this type of stuff is that the RRG lines are actually tracking the trends in this ratio. So in this case, it's the ratio versus $1. So you would expect that this corresponds with peaks. I mean, if you couldn't look any further than this, so at the end of 2018, this was sort of a peak in the market, and all these peaks in that equity correspond with peaks in the thing, because it is a ratio with something that's 1. So this is pretty much this is equal. The swings and stuff is equal as the one that you see in the chart above, and the momentum is the momentum of a trend here. So I don't know whether that is actually a relationship or an observation that it's logical that happens, I think, because it's directly derived. This is directly derived from this, because there's no relative anymore. These peaks and troughs will all align because they're both now in absolute terms, and this is measuring the trend in this absolute trends. It's measuring the absolute trends. So although the observation is correct, I am not entirely sure, or maybe I am entirely not sure, that this observation will help us analyzing these trends, because it is the top in the equity, because this is relative strength versus 1, so it is exactly lining up. It should, by default. And then the momentum picks up the bottoms and the tops, because momentum will also peak when this market peaks. So if you look at the RS momentum, these peaks correspond with peaks in momentum as well. And there you see that momentum, and here you see this is a divergence that you would see in any momentum indicator, but it's only a divergence here because it's versus $1, so it's in absolute terms. I hardly use any divergences in RRG lines because they're all relative, and that doesn't really work. But when you put it to $1, it all of a sudden becomes in absolute terms, and you can actually look at the divergences. And I would look actually at the divergences versus the RS momentum line. So I hope that this answers the question. I'm not sure about the validity or the added value of the observation of the peaks and troughs, but I absolutely do like using SPY and $1 together as benchmarks for a group of securities, no matter whether these are sectors or industries or individual stocks, to get two angles, one from an absolute point of view and one from a relative point of view, to keep you on the right side of the market. So that's definitely a valuable strategy and a valuable tool to use in combination with RRGs.
This was the 23rd episode of Sector Spotlight. Thank you for watching, and please don't be a stranger and stay in touch. We will continue to air Sector Spotlight every Tuesday from 10:30 to 11 a.m. Eastern. It will be pre-recorded as long as necessary, and we will go back to live versions as soon as possible. Meanwhile, if you want to read more about sectors and RRGs, please go to the RRG blog on StockCharts.com and subscribe using the link below each article to get a nudge every time a new article is posted. Stay safe, and I hope to see you back next week.